Welcome to a supplemental video update. These are videos that I like to do from time to time, in addition to the videos that I already post, where I take a topic and break it down a little bit further. This is one of those topics that I feel is very important that sometimes goes quite overlooked. This video is called Avoiding Massive Losses in the Stock Market. Wouldn't that be nice? Well, I'm going to tell you about a way that you can implement to take advantage of this concept. My name is John Clay, and I am with the SPX Investing Program. Although this video is not necessarily time dependent, meaning you can watch it anytime, why did I even think of putting together a video like this? I spend some time on Facebook joining different groups, especially groups about investing. There's one group that I joined about a year ago that deals with ARK Innovation and the ETF that's involved with that. And it's a very popular investment. You probably have heard about it if you're watching this video. There was a point in time when this ETF was really going up strong. However, near the early part of 2021, it hit a top and has been coming down ever since. While it was going up, this was a real dream for investors. I can get in, it's magically going to go up, and it seems like it's never going to stop. While it's been going down, it has turned into an absolute nightmare for some investors. Investors who bought ARK are likely very thoughtful, intelligent, and successful. These are not dumb people who are getting into this investment. They probably did their research. They thought about it over a period of time. They may have talked to other people in their family, some of their friends, maybe even consulted with a financial professional before getting into this investment. And some people put a lot of money into this. Cathie Wood, who is the head of the ARK Innovation ETF, she's become very common. You'll see her on TV a lot. And she also posts a lot of videos on YouTube. So after doing all of that, a lot of investors concluded that this would be an excellent investment. And at the time, it probably seemed like a really good idea. One post in particular really struck me in this Facebook group that I have been frequenting. This is the chart of ARK, and it goes back about 4 years, where it really saw a downturn during the COVID plunge, but then just came up right out of that really strong. The person who made the post in this group, after reading into what they said in their post and then replying to comments, it looks like they bought right at about the beginning of 2021, in January of that year. And it probably made a lot of sense at that time. You're thinking, okay, it has a pretty good track record, it's gone up, I'm going to sink my life savings into this. And then it started to go up after that. And they probably felt, okay, this is pretty cool. We're really going up. I'm already seeing a profit. Then it started to come back down. It's like, okay, well, it'll come back. And then it went down a little further. It'll come back. Then it went down even further. Oh, look, it's starting to come back. Nope, it stalled out, chopped sideways to lower. And then in late 2021, really started to go down. About the time that you see marked over here in late 2022, early 2023, this is when that person made the Facebook post. And they just said, I am so angry at Cathie Wood. Words cannot even begin to describe. Now I can't retire. Now I have to start over with my retirement fund. Unfortunately, this is just one example amongst pretty much all stocks out there. They all have up times and they all have down times. Just as an example, this is the S&P 500 in black. And this is what I focus on. All of the strategies that I do personally and that I teach in my classes have to do just with the S&P 500. And I have a whole reason behind all of that I won't get into here. The blue line is ARK. And you can see it was really going up. It was outpacing the S&P 500. Then it started to fall back. Then it came back up to where the S&P was. But then we started to see a divergence where the S&P kept going up. ARK started to go lower. And maybe you're getting a little uncomfortable right now saying, wait a minute, the S&P's been doing quite well, but ARK is really starting to see some pressure. We finally hit a top in the S&P. 2022 ended up being one of the most challenging years. We chopped all around, mainly going lower. Now it looks like, as we get into 2023, that things are looking a little bit better at the time I record this. But we could have some very difficult times ahead. In the meantime, ARK just kept going down and down and down, and that is very frustrating. My reason for this video is you don't have to go through this nightmare. Also, really good stocks like Microsoft. They've been a great investment for people over the years. They've been in a pretty solid uptrend. We hit 2022. They started to go down as well. Now they're starting to bounce back up. Also, the S&P 500, not immune to going up or down. We did really well up until the beginning of 2022. Then we've been chopping a lot lower. We finally hit a low in October of 2022, and it looks like things are getting better. Just to give you an example, what lies ahead at the time I record this video? So this is a bit time dependent. We just got over dealing with the debt ceiling, and Congress was finally able to pass the debt ceiling agreement and send it off to the president. The last time we really dealt with something like this was 2011. Well, the black line is what happened in 2011. The blue line is what's been happening right now. You can see after they made the debt deal, then we saw some weakness only to bounce back up. But then in the latter part of July and August, we saw some real weakness in the market. I'm not saying that's what's going to happen now, but if you compare it to 2011, there are some similarities between the two. Also, we're really fighting with, are we going to go into a recession? Are we not going to go into a recession? How would you like to take all that and just not worry about it anymore? I'm going to show you a way that you can do that. There should be a very different story going on here. There's no need for this kind of a nightmare to happen. There are vehicles available that you can use. Unfortunately, this is not the only story. There are thousands of good quality stocks like Microsoft, like Apple, like Amazon that do go through rough times. This can lead to disappointment, it can ruin your plans, and it can force you to reset the goals that you have established. However, with some knowledge, a little bit of experience, and setting things up in the right way, the story may not have this ultimate dream happy ending that you want, but it doesn't have to end in a complete disaster either. There is a way to protect, or think of it this way, insure your investments. It's likely that you own investments already that can take advantage of this strategy, and you may not even know about this. This strategy is really used by the smart money. These are the folks that really know what's going on. They have billions of dollars behind them, and they can actually drive the market up or down because of their volume and because they're so powerful. What we try to do is just jump on and figure out what they're doing and then do the same thing. All right, here's some questions. What if the worst thing that could happen to you is that you only suffer a small loss? Or possibly you get back to the point where you don't lose any money. The worst thing that can happen is you break even. Would that interest you? Also, what if you had a way of locking in your profits without having to sell an investment? Would that interest you? What if you do decide to sell a stock that once saw nice profits that have since evaporated? Is there a way to lock in those profits? So these are some things just to think about. And if any one of these questions apply to you, then keep listening to this video. Is this for real? Did you know about this strategy before watching this video? Maybe you did, maybe you didn't. This is really designed for people that are pretty new to the market and may have not heard of this before. But you might have been investing for decades and you're hearing about this for the first time. Please be aware that there is no conspiracy to keep this information from you. There's no hidden secret. This is all freely available information with freely available instruments that are very liquid, meaning that you can get in or get out quickly, and there's no secret behind all of this. It's just that few investors actually know that this strategy exists. There are lots of books that talk about this strategy. There's a lot of information online that you can go look at. And it goes beyond what I'm covering in this video. This video, as I said before, is designed for beginners and it's meant to explain the overall concept. That's all I want you to take away from this. I go much more in depth in some online courses that I make available that are not free. I do have some free courses that are available, but I go a lot more in depth on this topic as well as a lot of other topics. Not implementing this strategy is similar to not getting insurance. How would you like it if your house burned down and you didn't have any insurance? You got into a car accident, no insurance. You got sick, no insurance. What a nightmare that can create for you. Why not take that same concept and apply it to your portfolio? And it's also similar to driving a car without a seatbelt. Okay, 99 times everything might just go fine when you're driving that car without a seatbelt, but that one time when things go wrong, it could just wipe everything out. There are basically two rules of investing that I have come up with. I haven't got this from a book. This is just what I've seen over the decades of actually being involved in the market. Rule number one is don't lose money, okay? That's not usually the rule that we think of first. We usually think of rule number two, make money. That's why people get into the stock market, is to make money. However, it's common to skip rule 1 and just focus on rule 2. That's why we have a lot of these manias that go on. That's why we have a lot of these bubbles. People that don't really understand what they're doing, they're getting into a market because they see an automatic cash machine where they can just buy now and then 6 weeks later they can take that money out and woohoo, now they have lots more money that they didn't have before. The idea is that what goes up can also come down. Now, over the long term, things go up a lot more than they go down, but there are still these rough periods in the market that we have to be aware of. This can be dangerous, and it leads to a lot of disappointment, frustration, a sense of this isn't fair, and thinking, well, the stock market is just rigged. Those are the conclusions that people come to. Emotions also have to deal with it. Fear and greed, they are very powerful. The fear of missing out, the fear that you're going to lose, the fear that you don't have enough, and then the greed that you want more and more and more. The greed that you see somebody else has got a lot of money, now you want to have that for yourself as well. Now, some of those are not necessarily destructive, but taken too far, they can really hurt you. Wouldn't it be nice to remove as much emotion as possible? Some of you might have $50, $60, $100, $200, $300,000 on the line when you're getting into some of these investments. Wouldn't it be nice to remove the emotion from the equation as much as possible? It's never quite possible to remove all of it. There is human logic, and we use that in our everyday lives, in our occupations, in dealing with our families and friends. And then there is stock market logic, which is its own breed of animal. Often and typically, the two are completely opposite of each other. As I'm recording this right now, there's a lot to suggest that the market should be going down. What's it doing? It's going up. It defies logic. Now, we can always look behind us and say woulda, coulda, shoulda, but we need to make decisions right now based on what we see happening, and it's not always going to feel right. It's going to go against our human logic sometimes. For instance, based on personal experience, this is where I get this from, the best investments that I've had over the years, they don't always feel right. In fact, they never feel right at the time I get into them. This should be a warning sign to some of you. If you get into an investment and it feels good, that should throw off all kinds of warning signs. Doesn't mean that you're wrong. It just means you shouldn't necessarily feel that way. You're going with your own logic and now putting that onto the market. Investments that feel good can quickly change to despair. This is the whole bipolar thing. One day you're the king of the world. The next day I'm the scum of the earth. Basing investment decisions on feelings is pretty much gambling. You might as well go to Las Vegas. You'll have a lot more fun. You'll have a nice room to stay in. You'll have some good food. You'll see some entertainment. That is gambling. Now, I realize there is probability attached to everything that we do in life. There's probability driving a car, sitting in your house, doing anything that you do that something could go wrong. What we're trying to do is remove as much of the gambling from this equation and now stick with solid principles that we can implement so that we don't have to emotionally go through these things. What's the cost? Does this strategy cost money? Of course it does. Just like the insurance that you get, you have to pay for that. Is the desire that you have for a maximum return? We all want to get that. We want to take $1, turn it into $1 million with no risk in about 3 weeks. That's called the lottery. Or do you want to guard against unforeseen negative events? That's more real life, is the latter part of this sentence. Think of all the things that you could do in your life if you didn't have to pay for insurance. Yet, we just chalk it up as one of those necessary things in life. We insure our lives, we insure our health, we insure our homes, our cars, pretty much everything. We should also insure our investments. Many spend most of their lives building up an investment portfolio. Some of you have been working 30, 40, 50, 60 years at your job. You're getting ready to retire. The market's really running into trouble, and you're freaking out right now. Wouldn't it be nice to take that away as much as possible? In the market, any portfolio can lose value quickly. We saw how that happened back in 2022. Things looked like they were never going to come down, and yet down they came. Sometimes we also run out of time to rebuild. The gentleman that made that post, he says, I'm going to have to rebuild my retirement. What if you're in your late 50s or early 60s? You don't have time to rebuild from scratch again. Or if you're in your 20s or 30s, you have a chance of being able to do that. So this video aims to show you how you can avoid such a mess. Doesn't mean it's automatically going to happen because you have to implement what I'm talking about. This is going to take some discipline to be able to enact this over and over again and make this part of your overall strategy. All right, how do we apply protection? There are vehicles available that allow you to insure your investments. These are called put options. You might have heard of these before. Maybe you're hearing about it for the first time right now. The idea is a put option increases in value as something goes down in price. That's what we're trying to guard against here. Think of it like your insurance. You wreck your car, okay? Your insurance covers the price of the car. That's what we're trying to do here. They have existed since 1973, so they've been around quite a while. They are standardized, meaning that everything is the same when you're dealing with different put options, and they also trade on a public exchange, very similar to how stocks trade. Put options offer flexibility. You can tailor these to who you are. There are different ways that you can set these up to fit your personality, your style, your toleration for risk, your time that you have available. You can adjust it to those things. So it allows you to tailor them to fit your own investing style. Standardization. Let's go back and talk about that. There are many types of options. There's call options, there's put options. Those are the basic two kinds. But we will only focus on one kind in this video, put options. We're looking at something that will increase in value as the price of what you own is going down. Most options trade in Chicago at a thing called the CBOE. That's the Chicago Board Options Exchange. Feel free to Google it and see if it's for real, if you're hearing about this for the first time. One option contract covers 100 shares of stock. That's a standardization right there. If you buy 2 option contracts, that covers 200 shares. You have to do it in 100-share lots, is what they call those. The option life is also limited. If you buy a March option, that's the month where the option will expire. And you also may say, okay, March 2025. You know that it will expire in March of 2025. Example, a 50 March put, meaning that you can sell that stock at $50 per share. It will expire in March. That's typically on the 3rd Friday in March. Now, we have lots of different kinds of options now. What I'm talking about here are monthly options. They have weekly options. There are yearly options. This is focusing on monthly options. An option has a strike price. That's the 50 that you saw just a minute ago. This is the price at which you can sell your stock. For example, if you own 100 shares of just any old stock and it's at $50 per share, at the same time you buy that stock, you would buy one put that covers 100 shares that you just bought at a strike price of 50. Now, if your stock goes up, all right, you're doing pretty good. If the stock goes down, the put option will help make up the difference that you lose in the stock price itself. You have the right, but not the obligation, to sell your shares at $50 per share. What if you own a stock at $50 per share? You buy a put, just like I'm saying right here. It goes to 80. You don't have to still sell it for 50. You have the right, but not the obligation to sell at that price. What if that $50 stock drops to 20? All right, this is where we're talking. Now you still have the right to sell it at 50. You kind of get this? I'm going to go through lots of examples here. Everything in the option contract is standardized. They all cover 100 shares. They all expire at the same time. There are weekly, monthly, and yearly options. The only thing that changes is the price. That fluctuates every day. It goes up and down, and it's determined by the market. All the other parts of the option contracts are the same for all stocks. So here's the basic concept. After doing some research, you say, I want to buy a stock. It can be any stock. This stock has to be optionable. And that's a part that I'll go through again here. There is about 4,000 to 5,000 to 6,000 stocks out there that do have options available. So some stock that's a penny stock that's trading at 10 cents, no, it's probably not going to have options available. They usually have to be worth $5 or more per share. But the big names, Apple, Microsoft, Google, Intel, Amazon, They all have options that are available on them. The current price is $50 per share. So you decide, I like this stock. You check the box that says, yes, this is optionable. And now you go, okay, right now it's trading for $50 per share. The first step that you do is you buy 100 shares. You get on your brokerage account, you call them on the phone. However you do it, your cost, and I'm not including commissions in this whole example, it's $5,000. You bought 100 shares at $50 a share, so that's $5,000. Then the step 2, and this is what it should be. At the same time, right the second you get the confirmation that you bought that stock, you immediately buy one December, and it could be any month. I'm just using this as an example. You buy one December put option at a strike price of 50. Okay? Your cost, which again doesn't count for commissions, is approximately $500 for that put option. And it's about 10% of the purchase price in this example. The purchased option will expire on the third Friday in December. I'm just using this as an overall way to explain the concept. This will protect your initial investment for about $83 per month. At the time I record this, at the beginning of June, we have 6-7 months until the end of the year. So if we take that $500 and divide it, it's about $83 per month. If things go right, let's say you're a genius at picking stocks. The purchased stock increased in value after you bought it. But you didn't know that at the time. It just went up. By December, you look at the price again, and it's gone up from $50 a share where you bought it. Now it's trading at $70 per share. Congratulate yourself. That is a 40% increase. The purchase put option, that's still at 50, it'll now be worthless. Okay, you bought insurance and you didn't need it. The total profit will decrease by the $500 that you spent buying the put option. You took out $7,000. You had $5,000 for your investment. That gives you $2,000. Now you take out another $500 for the put option. So your total return on this particular trade is $1,500. If you think this is not fair, just ask yourself this question. Do I get my money back if my house doesn't burn down? If I don't get sick? Or my car was not in an accident? No, you might get some kind of break along the line or be chalked up as some kind of great customer, but you don't get all that money back when you're buying insurance. The same thing is true when you're right. The only time this insurance kicks in is when you're wrong or when there's been a mistake. Let's look at when things go wrong. The purchased stock decreased in value after you bought it. By December, the price has gone down to $30 per share. You bought it at 50, now it's down to 30. That's a 40% decrease. The purchase put option at 50 will now be worth at least, and I'll explain why I have this underlined, it'll be worth at least $2,000. The total loss will be $500. The $500 that you paid for the put option, so that's what your outlay is. The price of the put option still produces a loss. However, would you rather lose $500 or $2,000 in this example? Think of this as a deductible. Sometimes you're still going to have a little bit of chunks going out that you're going to lose, and that's going to affect your overall return. There is a chance, however, but it's not a guarantee, that the value of the put option that you bought, it will increase enough to cover your stock losses completely, as well as the cost of the put option. This can happen, and there are instances when you go to sell that put option to cover your losses, and it will be more than enough than what you spent for the stock and for the put itself. But there's no guarantee that it's always going to work out that way. Let's use ARK as an example. ARK was trading at about $140 per share in January 2021. That's when the gentleman I'm referring to bought into the stock. You buy 100 shares for $14,000. 100 shares at 140, that's 14 grand. At the same time, and this is where a lot of people mess up, there's also another mechanism where you can buy stock and then also sell an option at the same time. That's not what I'm talking about here. You need to buy the stock and then buy the put option. So you buy a January 2023 put option. That gives you 2 years of protection because this is January 2021. It has a strike price of $140 per share. That costs you $750 or 3.4% of the purchase price. Your total cost is not only the 14 grand you paid for the stock, but an additional $750 that you have to pay for the put option. By December 2022, the price fell to $30 per share. And that's what really happened. I could go back and show you the chart. Just remember what we were looking at. It did fall to $30 per share. That's a 78.6% loss. You still have an agreement that says you can sell at $140. It can now be sold for at least $11,000. Are you catching the power of this right now? The total loss will be the $750. The cost of the put option, that is your deductible. The price of the put option still produces a small loss. However, would you rather lose $11,000 or $750? There is a chance, just like before, but it's not a guarantee that the put option may be going down so far so fast that it can cover all of your expenses. It's not always going to happen that way, but it can happen. All right, locking in profits. Let's look at a different example. You purchased a stock in January of any year at $50 per share, and it's done pretty well. By December of that year, 12 months later, the price has gone up to $70 per share. That's another 40% increase. The purchase put option that you bought at $50 that lasts until December, it'll be worthless. You had insurance and you didn't need to use it. The total profit will decrease to $1,500, the $7,000 that you took in when you sold, minus the $5,000 that you initially put up, that gives you $2,000, and then $500 for the put option, which is totaling $1,500. Now you want to lock in your profits. That's what you did in step 1. Now you have to start implementing step 2. You buy a January 70 put that gives you 2 years of protection. The first put option that you bought, it's December of the same year. It's going to expire worthless. Now you can go out again and buy more insurance. But now the stock has gone up. And you not only want to protect your investment, but you want to protect the gains that you've seen in that investment. Some problems hit the market. Think back to the beginning of 2022. Think back to what stocks you own were doing. They were starting to go down and they were going down fast. The price again falls to $30 per share. The put option that you have is now worth at least, and it could be more than this, you can sell that put option and then that will cover your profits as well as the initial purchase of the stock. Your total cost above and beyond buying the stock is now $1,250. However, you can keep the $2,000 of profit the stock had experienced in addition to preserving your initial investment of $5,000. $1,250 is used to protect the $7,000, and it costs about 18% in order to do that. Is it worth 18% to you to implement some kind of a strategy like this? Only you can really answer that. All right, let's use ARK as an example. After the COVID plunge, ARK was starting to bounce up, and at the time in March or April of 2020, it got back up to about $60 per share. You buy 100 shares for $6,000. At the same time, you buy a January 2021 put option, which gives you 9 months of protection, because this was March when you initiated this. You have all the way until January where you're covered, and it has a strike price of $60, the same price where you got in, and it costs you $500 to protect your initial investment. Your total purchase price was the $6,000 for the stock and an additional $500 for the option. By January 2021, the price goes up over $150 a share. It got to a high of $158. Your initial put option that expires in December, you're still shooting higher. Now, you don't have that put option anymore. You can buy another put option for January 2023, which gives you a whole year with a strike price of $150 per share. Can you see how this makes sense? You bought at $60. You're now locking in your profits at $150, and that will cost you $750. You're protecting your initial investment as well as some really nice profits that you've been able to enjoy. ARK falls just like it did in real life, and by December 2022, when that gentleman made the post, there's still 1 month left on your protection. Your option has not expired yet. It doesn't expire until January 2023. The stock is now trading at $30 per share. And you decide, screw this, I'm done. I don't want anything more to do with ARK. I can sell the stock and get some of my money back there. I can sell the put option, cover my losses. I can also bring in a lot of the gains that I did have at times gone by. The purchase put option for $150 can now be sold for at least $12,000. You sell both the stock, you bring in $3,000 for that. You sell the put option, you bring in at least $12,000 for that. So you're bringing in $15,000 overall. After subtracting the cost of the two put options, which are $1,250, you now have a profit of $13,750. You received all of your initial investment back. Remember, you put in $6,000. You also have an additional $7,750 in profits. Your total return's 129%. Woohoo! Even after you sat and watched ARK crater day after day after day, and it looked like it was never going to stop falling. There is a chance, as I said before, but not a guarantee, that ARK might have been falling so far so fast that the value of that put option may be even greater. I'm just saying at least this certain amount, and I'll explain about that more. Okay, why do I say that? The price of any option is made up of two parts. You have what's called the intrinsic value. This is the real value. It's what we say when a $50 stock drops to 40. What would the intrinsic value be for the put option? If the put option is at 50, it would be 10. So we know it's going to be worth at least 10. And every time the stock goes down 1 point, the put option goes up 1 point, 1 for 1. For example, a put option that is $10 in the money, that's what we call that, will be worth at least $10. Then we have to multiply that by 100, and that will actually be worth $1,000. Then there's the extrinsic value, and this is where it gets a little complicated. This is added fluff to the price, and it's based on a lot of different variables, which can include, but is not limited to, the time left in the option. Options that last longer cost more. Options that are going to expire in a week cost less than options that are going to expire in a year. Also, the volatility of the stock. If you buy insurance for a house and nothing bad has ever happened in that area, your insurance is probably going to be cheaper. But if you buy a house on top of an active volcano, that's going to cost you a lot for that insurance. The same thing is true with stocks. There are some stocks that just kind of boring, chop around, don't really move up, don't really move down, day after day, year after year. And then there are other stocks that just zip up, zip down, kind of like ARK. Well, the volatility also can increase the price of the put option. That can add more to your cost when you go to buy. It can also help you when you go to sell. At any given time, both are added together. The intrinsic and the extrinsic value are combined together to give you the overall price of the option. They use software for this. There's monster computers that calculate this multiple times every minute for all the stocks out there that are optionable, and they recalculate the prices as fast as they can. The closer the put option is to expiring, the less influence there will be from the extrinsic value. As I said, an option expiring next week won't have as much of intrinsic value as an option that's expiring in a year because there's more chances for things to happen within that 1 year period. At the end of the last trading day, that's the third Friday of the month, if we're just assuming these are monthly options, it will be left with only intrinsic value, if any. If it doesn't have any intrinsic value, it then expires worthless. This is one thing that I want to address really quick. When people look at options, one of the first negatives that they hear is most options expire worthless. Yes, they're supposed to. There's a lot of options that people use to protect themselves, like what we're talking about here, and they didn't need that protection. So yes, there are a lot that expire worthless. Finding information about put options is found online pretty easily. There's stockcharts.com, and I'm going to take you to these sites. You can go to Yahoo Finance and your brokerage. If you have an online broker and they have a platform that you can use, chances are there's option information there. How do you apply this protection? The first thing you have to do is say, is the stock optionable? Most of the big stocks that you've heard of, they do have options, but some of these new fly-by-night companies, they may not have options available on them. Also, you remember Silicon Valley Bank? They had options, but now that they're down at 35 cents or something, their options are no longer traded. So things can change. There's a website where I did a quick Google search to find this, and I'm going to take you to this site. There will be some work that you need to do in order to pick the best options that work for you. Do you want to be fully insured? Are you willing to take a bit of a deductible? Do you want to do this once a month? Do you want to just set it up once a year? All of this is going to be tailored to you. Variations can be made depending on how much effort you want to put into this and how much time you have available. There are also methods that can be implemented to cover the cost of your protection. That's beyond what I want to talk about here, but I do talk about this in my online class. This is called covered call writing, where you sell an option and then you can use the money that you brought in to pay for the protection. There's some good points to that and some bad points to that, and that is for another time. This video was designed to only provide the basic overview of the concept. If keeping up with the daily and weekly movement and outlook of the market is something that can help you, I post videos every day. I have weekly videos. I have an intermarket analysis video. I post 5 videos every day of the week and then 3 additional videos over the weekend. That might help you because knowing where we're at within the market could very well help you make better decisions. I also have a free stock market course that you're welcome to take. It's right on YouTube or Rumble. It's freely available to you. I intend to re-record the outdated parts. It's a few years old now. There are some parts of this course that never change, and I'm not going to re-record those. But sometimes I use charts and I use current examples. Over the summer of 2023, I intend to re-record the outdated parts. I am not a financial professional. Please be aware of that. I never have been, and I never want to be a broker, a financial planner, a tax professional. I don't want to be any of that stuff. I am an educator, and that's my calling, and that's what I do. My desire is to give you information to make your life better. That's all I want to do here, folks. If you're interested, here is a link to my YouTube channel, which if you're already watching this, you got to that YouTube channel. Then I also have a channel on Rumble, and here is also the channel where you can find the videos that I post. So one final thought. If this is a new concept to you, you might be really tempted right now to kick yourself for not knowing about it. Oh man, I wish I'd known about this 10 years ago, 10 months ago, 10 days ago. Unfortunately, we can't do anything about what has already happened. It's like buying insurance on your house when it's already on fire. It's just not going to happen. But with millions of participants in the stock market, not knowing this concept is fairly common. The important thing is to learn and then take things forward from that point. That's all you can do right now. Here is the first website, and I just did a Google search. I'd never been to this site before I recorded this video. I have different ways of looking up information. But if you want to find out if a stock is optionable or not, you go to poweropt.com, and they have an alphabetical list. Let's see. Do they have options for ARK? Well, first of all, we need to drop this down to 100 results. And then we type in the symbol ARKK, and boom, look it. There are options for ARK. Okay, what about Apple? AAPL. Yes, there's multiple kinds of options for Apple. What about Google? We have to click on the G right here and then type in the symbol. There's Class C shares and there's Class A shares, and there's options for both of them. I think you get the idea. This would be a good site to come to, and I'll put this in the description below the video, where you can just check out a stock, the name of a stock, or by the symbol, and then say, okay, they have options, so now I'm able to protect myself. Personally, I use this as a filter. I never, ever want to buy a stock that is not optionable. You're taking a lot of opportunities, a lot of options, pardon the pun, off of the table. There are things that you can do with optionable stocks that you just can't do otherwise. It's not always about capital gains. All right, let's look at another site. This is Yahoo Finance, where I already typed in ARK Innovation. And then you can click on the options, and this gives you a list of all the options. Now, before you do that, you can go over here and look at all the different expiration times. And these go all the way out to 2025. So you can find some option information there. Also, if you already belong to stockcharts.com, and that's where I get all my charts from, they have option chains, that's what these are called, at stockcharts.com, and you don't even have to be a member. I'm not logged into my account right now, and I was able to access this. This is also on ARK and gives you the calls are on the left and the puts are on the right. We're focusing just on the puts for this particular video. So there's lots of information out there. So thank you. I really hope you found this helpful. I would love to hear from you. I would love to have you start watching the different videos that I post. I really, really, really hope that you find this insightful for you. You can take this information, build on it, and then develop it into your own method. So have a great week, and I will talk to you the next time I record a video.